the relationship between interest and inflation as a lever to control inflation is not at all straightforward. Interest is, think of it, say you're a landlord and you own your properties with large mortgages and you rent them out and the mortgage rate rises. What are you going to do? You're going to put up the rents.
Yeah.
And rents are included in the inflation measure. So actually, the interest feeds through to higher rent. The higher interest feeds through to higher rents that feed through to higher inflation. From the perspective of the government, once governments operate with very high levels of debt, and as I point out in the book, when the cost of leverage, the cost of borrowing was very low, close to zero short term. What did the governments do? Surprise, surprise, they borrowed a hell of a lot of money. So now they've got a lot of money and interest rates start rising. And that means the government finances are constrained because now, probably I'm saying, the interest charge in the UK as a share of government spending is
10
probably
10 to 15%, is it?
Yeah, it's probably in the range. I was going to say sort of 12 to 15%, somewhere.
As big as state pension
somewhere in that range. So, what do governments do when they come under pressure? They don't go bust because they can print money. So why would you bother to go bust? So obviously, they have an inducement to print money, and that means that you're going to get higher inflation in future. So the rise in the interest rate undermines the stability of government financing, and the undermining of the stability of government financing presages
more money, which causes inflation. You have to rise the interest rate.
Everything is, and funnily enough, it also works strangely enough the other way around. Again, this is something that the policymakers don't seem to understand, which is actually that low interest rates can be deflationary. And one way to think of it this way is that you lower, with households, you lower the rate of interest, they take on more debt. Once they've taken on more debt, because they buy themselves a car, they go on holiday, blah, 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 they brought their consumption from the future into the present. And then that present, sadly, is in the past. And that means they've got less consumption, potential consumption going forward. And what happens when you have lower potential consumption going forward? Well, you have a sort of spending drag, a deflationary drag. When companies take on more debt, they have to invest less and so forth. And therefore, you have a deflationary drag there. So actually, the low interest rates feed deflation. I'm not saying in every case, and the high interest rates can feed inflation. So the way it's conventionally looked at is possibly diametrically wrong.
They call that a blunt tool.
Yeah,
it is a blunt tool.
Very blunt.
So you don't think that the interest can be used as a lever to control inflation? Because we hear all the time, but do you think it's a lot more diluted and not correlated than we think?
Well,
or there's other factors.
So in extreme, I think one has to think how does it work, the interest rate, and if I think the mechanism by which it works is, in the end, by pushing up unemployment and inducing financial problems. And that's why often, when you've got long bonds, when short-term interest rates rise and long bond yields stay more or less in the same place, that you get what we call an inverted bond yield or yield curve, so that short-term rates are higher than long-term rates, and that stays in bed, and that inverted yield curve, so tight short-term money, normally presages recessions. Not always. We've had a very long period of an inverted yield curve, and we haven't had a recession yet. But I think the general mechanism is that higher rates kill off inflation by not directly, but through smashing the economy or financial system. And think back to the global financial crisis. I mean, in the US in 2001, 2002, took interest rates down to 1%. It was in the wake of the dot-com bubble. And then, they got this sort of, US property bubble forming because, money cost of borrowing was very cheap. And then from 2004 onwards, interest rates started to rise. And it's hard to believe it now, but even in 2007, mid-2007, people thought everything was safe and the central bank still kept money tight. And then, the whole subprime debacle came down upon us. So there was a case where they'd innocently raised interest rates and they had, not the foggiest of what was about to hit them. So, a blunt tool. And not just a blunt tool, a tool that works, as the American economist Milton Friedman says, with long and variable lags. So it's not just blunt. You don't even quite know when the hammer's going to hit its victim. It could be 6 months, it could be a year, it could be 2 or 3 years.
You're swinging a very long, dull sword in the dark, basically.
Yeah.
That was a clip from our full-length interview with Edward Chancellor about the impact of ultra-low interest rates. You can watch the full episode right here.